Hey everybody, Courtney Smith here, and it's time for that moment you've been waiting for, our weekly video newsletter, TradeSmith. Let's just dive right into it. Here's the disclaimer that I'd really like you to look at closely. As always, do not trade with money that you cannot afford to lose. All right, let's get right into this. So first of all, a lot of different things happen this week. I think this coming week is going to be a super important one. Let's take a look here at the S&P 500. Upper left-hand corner, you got some red squiggles. That's just to remind you that I've been talking about this resistance above the market that's going to stop the market from moving higher. We've moved to an area where there's lots of resistance and the market's gotten a bit overvalued. So another thing, look at the three humps on the right, the red humps. That's a potential head and shoulders top formation. That would be bearish if it broke the horizontal green line at about 2040. Let's say a close below 2040 would be a completion of this formation. Now down at the bottom, you see that I've got a green downward slanting line there. And that shows that over the recent several weeks, we've seen a decline in volume. That's a confirming factor that this head and shoulders is a valid head and shoulders. Now, it hasn't broken the trend line, the neckline yet at 2040. But if it does, we already know that the volume is confirming the breakdown. What you should see in a head and shoulders is that volume declining, particularly on the right-hand side of the formation. So this looks pretty bearish to me. But of course, just because it's bearish doesn't mean we can't make a lot of money. So if it breaks below 2040, you need to go short. You need to buy a put on the SPY. You need to do something like that to start making some money on the short side. Let's carry on. Pretty much the same thing in the Dow Jones. But notice, I didn't draw the line on there, but notice we're making lower lows already. And so the neckline has already been broken in the head and shoulders top on the Dow Jones. What about over on the Nasdaq? Well, the Nasdaq is just in a bear market already. We're making lower highs. We haven't made lower lows, but boy, all we have to do is break below about 46.95, which could occur on Monday, and we're in a bear market there. Overall, the price action is bearish or just about to turn clearly bearish, such as a lower low on this chart. Seasonality, this is where our line is. Notice we're also breaking to new lows here on the IWM, the Russell 2000. A break of 108, which we're just barely above, would get me out of my bullish seasonality and turn me to the bear side. So instead of taking big risk on trades, I'd be taking teeny tiny risk on trade. This is right now one of the bullish features of the market. And as you can see, it's very close to, this IWM has to turn around and go up very soon, or this thing's turning bearish. Seasonality, we talked about that before. The yield curve, we're in a period from a year ago where the orange line is, where we should be chop, 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 but still this is generally a bullish factor for the market. But it's a background factor. Asset allocation, you can see they're moving money out of the stock market and our indicator is going lower. They're moving it back into the bond market. And even if they're in the stock market, they don't want to be in anything risky. The only two S&P sectors that are going in bull markets right now are utilities and consumer staples. Those are the only two sectors that were up in January and February. We're back to that. All right, global shares are participating in this global bear market in stocks, so we don't want to be aggressive in stocks, not global shares. Spanish shares, I'm not going to cover them anymore because we're clearly starting to move lower. So I got excited there for a little while, but I'm not anymore. I'm also not excited about the UK shares. They held up great and then cracked a week and a half ago. The only area that I'm still bullish on are Greek shares. You can see we're in a clear bull market here. And since I told you to get involved, we're up quite a bit, probably about 10% in just about 3 or 4 weeks. So nice trade over here. Bonds, we're up towards the high end of our range. So I'm not looking for the bonds to go too much higher. That downtrend line, that green line slanting down, is going to cap any further bond prices. So not, will they go down a lot? No, not at all. This is a safe haven that a lot of people are moving into. Not me, because I want to make some money. I don't want safety. I want money. Bond key factors. The top one is the gold line, and that's pointing up. That suggests higher interest rates or lower bond prices. But if you look at the chart itself, the CRB, it's also pointing up. That would be calling for higher interest rates. The third factor is the blue line. That's German 10-year treasuries, and that's pointing for stable or lower interest rates. So a bit of a mixed bag, but generally speaking, we should expect this market to turn around and start to go down based on 2 out of our 3 key factors are suggesting higher interest rates ahead. And higher interest rates means lower prices. That's the way bonds work. What can I tell you? All right, the dollar. I've got an orange line going across. Well, first of all, the down slanting green trend line was broken very decisively. So I thought we'd stabilize a bit more around that 94 area, maybe go down a little bit. The market staggered there for a couple of days and then blew up through it. The next resistance above the market is there about 95.25, and I got to believe that that's going to hold at this point. If it doesn't, I'm switching to the bull side. I'm going to get long the dollar. But right now, I need to see it break that orange horizontal line at 95.25 before getting on the bull side. Gold, because of the strength in the dollar, has been forming a little flag formation. Now, a flag formation, that's a good example of one. It's a counter trend move, but you can see it's kind of choppy and down. It's no strong bear market by any means. And notice down at the bottom, I'm showing you how volume is declining as we go through the flag formation. So I look for now gold to break out to the upside just as the dollar starts to break down. If the dollar breaks up, then I'm going to reverse that and suggest that gold will enter into a bear market. But at this point, looking purely at gold, this looks like it's about to break to the upside. And if it does, if we break out of this flag formation, I want to be long gold. I want to get back onto the bull side of gold. There's a lot of good factors out there causing it to be bullish. However, let's look at our 3 key indicators. The top one has kind of turned down. The middle one, the brown one, is pretty much sideways. And the one on the bottom, the green line, it's kind of turning down. None of them significant, but all of this is also why gold is not doing that well. These 3 factors need to turn decisively back up again. Oil, very interesting here. First of all, I look for oil to sell off this week. And I look for it to sell off for 2 reasons. Number one, let's look at the red lines. You can see that prices made new higher closes. But the green line, the squiggly green line, where the second red line is, that's the RSI, the Relative Strength Index, and it did not make a new high. When the price makes a new high and the RSI doesn't, that's called an RSI divergence, and it would suggest that oil is going to sell off this week. Another reason for believing that oil is going to sell off this week are my 2 green lines. The top green line is slanted up, showing that the prices rallied over the last week. But look at what happened to volume down at the bottom. Volume just fell out of bed. Well, what that means is if the price is going up and the volume is going down, volume should confirm the move, and it's undercutting the move instead. In other words, it's saying that this is a false breakout and that the breakout will fail very soon. Hey, everybody, thanks very much. Love doing these for you every week. And welcome to all our new podcasts. We've turned the TradeSmith into the free version of it into a podcast that you can sign up to on iTunes, and it'll automatically download. It's pretty super cool. Anyway, you get all this great stuff. Of course, we'd love to have you on the fully paid version, which is only $47 a month. But all you new podcast viewers, welcome. And we'll see all of you next week. Now go make a bunch of money. I'll see you next week. Thanks very much. All you fully paid up members, though, you guys hang on.